Realty Income. Their ticker symbol is O. They're currently priced in $63.77. Their current market cap is $59.4 billion. For their dividend yield, right now is 5.07% yield, which is paid every month. This is the biggest net lease REIT in the world right now, and I spent, some time digging into whether this is still deserves its nickname, which made it famous. So I'm gonna make a quick brief about Reality Income. Latest news. So four things you need to know before we go anywhere. So on June 13th, actually, Reality Income announced a $1.4 billion joint venture with Cloud Capital to buy Northern Virginia data centers. Seed portfolio worth about 6 billion. This is Reality Income moving into the digital infrastructure at scale for the first time. On June 20th, 29th, they priced 600 million euros in a senior note at 3.625% and refreshed their at the market equity program. Fresh funding both sides of the balance sheet. On May 14th, they declared their 671st consecutive monthly dividend. So it's been great. That streak is now over 55 years uninterrupted so far. And on the analyst side, Stiffit, I think that's how you pronounce it, raised its target to $70, which it did not too long ago, close to it. Yeah, and 75 cents with a buy. Beard, yeah, raised to 65 with a hold, and consensus target sits at 67 and 91. About 6% upside from here now into the business side of it. All right, so for the executive summary, there's three ways to read Reality Income right now. Just a basic rundown for the bull case. So rates kind of ease off into 2027 for the bull case. The data center for JV compounds Reality Incomes, FFO, growth beyond its low single digit REIT baseline. Yield plus growth beats the S&P over 5 years. The best net lease operator, Realty Income gets awarded for scale and diversification. So ideally, the target zone would be $75 plus. The neutral case, the rate holds stays flat. Business grinds for at 4 to 5% AAFFO growth. Monthly dividend keeps ticking, which has been doing. And the stock rebound range bound. The data center JV is a real business, but it takes years to move the needle on a 60 billion market cap. Target zone is roughly $65 to $70. Lastly, for the bear case, rates stay high or rise. Retail tenants default at higher rates in a downturn. As for data centers, they pivot to the boring monthly income thesis without adding meaningful cash flows for years. Equity issuance, keeps diluting shareholders. And the target zone will be $55 to $60, which is currently with the price right now, price wise. All right, so how reality incomes actually make money and actually work. All right, so they actually own the building, they sign a long lease, collect rent monthly. They pay out monthly too. That is the whole business in one sentence. As for the mechanic side of it, another term, is triple net leasing. So the tenant pays rent and also property taxes, insurance, and maintenance. Reality income just collects. Scale is where it gets interesting. So 15,500 properties, 50 US states, also counting the UK and 8 other European nations. Tenants, they have something like Dollar General, 7-Eleven, Walgreens, and wine resorts, LA Fitness, and more, etc. So the average lease, is around 9 years as of last month. Hyperscale data centers via Cloud Capital JV, same triple net structure, different tenant profile, investment grade AI, and cloud infrastructure operators lock in for 15 to 20 years. All right, so for the numbers. So back in 2025, the revenue was 5.76 billion. They're up 9.2% compared to 2024. And the net income was 1.6 billion. They're up 24.8% year to year. For Q1 itself, the net income was 312 million. They're up 24.8%. And their EBITDA is currently 1.27 billion, and they're up 11.4%, which are doing great. And as you can see, the revenue trend here is growing year by year, which is good, especially for us who own Realty Income. Which just for clarification, I do own Realty Income, so anything what I say could be biased or anything. But again, do your own research. Everything I'm just sharing just for entertainment for purposes. So the cash engine. So it is 848 million free cash flow for Q1 2026. They're up 7.7% year over year. Currently, they're at 671 consecutive monthly dividend paid, 130 plus increase since the IPO back in 1994. So for cash flow, so rent comes in monthly. Most of it goes out monthly. The rest funds the next acquisition. So in Q1, Realty Income collected roughly 1.4 billion in rent. Operating cash was 875 million. Free cash flow 848 million, and about 720 million paid to owners and for the monthly dividend holders to shareholders. So that's basically the loop for Realty Income. So here's the real tension. So the dividend gets covered, but the growth acquisition requires new capital, every year. Reality Income funds that up through, debt and its own ATM, equity program. Rising rates, will really make the debt even more expensive depending on the rate they locked into. And the new shares dilutes to existing owners. And the 1.4 billion data centers commitment is the biggest single deployment in years for Realty Income, and it'll really test how well that funding model, will scale for the next few months or even years. All right, so for capital allocation, so every dollar of cash flow has one of three jobs: the dividend job, so 671 months paid, no interruption so far through 2008, COVID, or any other rate cycles that happened in the past. This is the promise that cannot break. The growth job, two, $4 billion of net acquisition in a normal year, 1.4 billion just committed to data centers, US retail, industrial gaming, European retail, and now even digital infrastructure. So it's quite diversified enough to not have a single sector can be sink in the ship if something really happens. And the balance sheet job. So 30 billion in debt, 370 million in cash. Recently, 600 million euro note offering, locks in European funding, investment grade credit rating is protected as the top priority behind the dividend itself. Reality Income does not control rates. They cannot control rates. The rate controls Reality Income. So there's two tailwinds. AI infrastructure demand push multi-year data center contract, the capacity built out, and now Realty Income has a programmatic vehicle to keep buying that exposure. European expansion added a whole new addressable market with, with cheaper local funding. Two, headwinds. Interest rate uncertainty, every quarter of a higher for a longer language compressed the multiple. This is the single biggest driver of the share price in 2026 last year. And as for the retail tenant pressure, dollar store, drug chains, mid-tier discounters, some of Realty Income's biggest tenant categories face secular, decline. So, but again, diversification helps, but it does not eliminate the drag that's happening. For competitive position, again, Realty Income is the biggest net lease REIT in the world right now. Not the only one that matters though. The most is that three things: cost of capital, because a bigger balance sheet means cheaper debt and better rating than the next tier. Tenant relationships, because of national retailers keeps coming back for sell leasebacks. The most reliable counterparties and diversification across 1,500 plus tenants, what they have. 90 plus, 90 plus of them, like industries, 11 countries, and now data centers. Peers know that, agree like Reality Income has higher growth but less scale. As for N REIT, it's much simpler, but it's only US only. And another one's quite good is WP Carry, but it actually cut its dividend back in 2023, which is which is exactly the outcome income investors are trying to avoid. As for digital reality, is now partial competitor in the data center lane. Simon is a mall REIT, different, quite different business entirely as of right now. So the risk register, so there's actually four risks. So interest rate volatility is high. A single Fed comment, quarter can knock 5 to 10% off the stock, regardless of the business performance. The retail tenants decline is medium, diversified, but the drag is real. Data center execution is medium. It is a new sector, still building out the muscle, but equity dilution is medium. Growth funded partially through ATM issuance. Per share metrics need to outrun the share count. So what has to be true? So for the bull case, needs Fed rate cuts. Data center JV growing into 10 plus assets. AFFO per share compounding at 68%, and multiple expansion target about 75. Neutral, stays flat, for the 5% AFFO growth and the multiple holdings stay steady. We just target around 65 to $70. And then for the bear case, again, you know, the rates stay high, the tenant defaults, and it's going to take up, it's going to pile up. The data center pivots, diluting the thesis without moving the numbers, and equity insurance, eating returns. And the target for them is like 55 to 60. But yeah, that's reality income. So 671 months of dividend. It's not per luck. It is a machine built for one thing. So whether that machine stays the best in class depends on two bets. How reality income executes on the data center and what the Fed actually decides with the rates. But again, everything, is just noise. But that's really pretty much it, what I have for reality income. All right, thanks.